All right, everybody. Welcome to another episode of the Stock Bros Podcast. My name's Tony. Unfortunately, my brother couldn't join again. I tried to get him to go, but my niece is giving him a hard time. So
Kids. Yeah.
yeah, you know how it is.
I know it.
So today we got Johnny Margarito. We got Lloyd Ross. We got Lloyd's millionaire investor. He's an entrepreneur extraordinaire. He's an author.
Yep.
We got Johnny Margarito. He's the admin of a 30,000 member stock market for beginners Facebook group. He's got his own company, Wiseman Traders. He does coaching. He does weekly reports telling you what are the best stocks coming out. He's very experienced, and today I'm excited to have them both on. Welcome,
Thank
guys.
you, Tony.
Thanks for having us on, man.
Glad to be here.
Yeah, let's go.
So we took some questions from our Facebook group, and we asked people what they wanted to know from you guys. And I wrote down a bunch of stuff, and some of the topics we're going to be talking about your first investments. We're going to talk about your best investments. We're going to talk about the climate of the market in general. We're going to talk about the new stimulus package just passed the United States. We're going to talk about are we headed for a market crash or correction? We're going to talk about interest rates, bonds, rise of the meme stock era. We're going to be talking about all that stuff. We're going to get to a couple other questions. So first, why don't we go ahead and start off with each of you telling us about your first investments you've made.
Yeah, so you want to go first, Johnny, or you want me?
Yeah, you can go first.
Cool. First investment I ever made. Oh, it was an investment in myself. What about that for a cliche?
That's a good one.
I picked up a book. Actually, it was in grade 11. Didn't know anything about money at that point. Grade 11 in school. And my year 11 English teacher. Weird place to learn about money and investing in English class, right? Like it wouldn't happen. And they say you learn nothing at school about money and investing, but I did. He said to us, gentlemen, when you leave school, pick up Robert Kiyosaki's Rich Dad, Poor Dad and The Richest Man in Babylon and read those two books. And I guess that would be the best piece of money advice from school I ever picked up. And so, I went and read them, and that was probably my first investment in myself, I would say. In terms of a stock, which is what everyone wants to hear about.
That's what everybody wants to know.
I know. So I saved up about $3,000, I think it was, and I bought a dividend producing stock. It won actually Australia's oldest bank. It was 200 years old. It's called Westpac Bank, and it's paying a 6% fully franked dividend yield, which means 6% cash return in dividends and untaxable, which means it was tax-free income. So, and I bought the bank, and that's what I did. Still got the shares.
So did you? Wow, that's incredible. So did you buy that just for the dividend income, or did you think, I'm going to hold this and get some capital appreciation?
Both.
All right.
And most importantly, I knew I wouldn't lose my money.
Nice.
So that was it. 200 years old, man. I was going to keep going. I want to buy it. Banks.
Wise.
They run the country here. And I was like, I'm just going to buy the banks. That's what I did. That's how I started. And I got paid my first dividend check, and that's when I realized that money grows on trees. That's what I knew.
Nice.
How about you, Johnny?
I think my first, they weren't investments because I was 23 years old. I picked up Facebook, I think Microsoft, the things I was using, like how everybody said. And that first week I was mad because I only increased like 1% off of each. So like when I first started, I was trading and searching for the daily movers. So I definitely learned the hard way. And after a couple months, I definitely had to search for the fundamentals, and I had to get to the books to really learn. So I learned the hard way.
Most people do.
Right. And I'm only holding Microsoft out of those. But I definitely traded those my first pickups that were gone that first week. And I was on to daily movers and stuff. So I was heading towards the wrong path when I first started, but I got it together within like 3 months after losing a couple $100 because I was putting money like 500 in at a time. So I learned the hard way. So that's why that's one of my priorities is to help people avoid that, because it sucked. There was a lot of headaches.
For sure, for sure. And so what was your guys' best investment, would you say, other than investing in yourself, Lloyd? Come on, give us some real stuff here.
Okay. Well, I reckon Berkshire Hathaway for me was my biggest and best, because I remember reading Warren Buffett's book, The Snowball by Alice Schroeder, then The Intelligent Investor, and then I read everything by Warren Buffett. Letters to shareholders, I really read every annual report by that company, and I just knew it was a great business. And it's a group of businesses run by the smartest guy in investing history. It was a no-brainer. Yeah. I was like, he knows more than me. He has a better company. It's undervalued. I bought it at $80 a share.
Wow. Yeah, that's
wow.
For those listening, that's Class B shares. Class B.
Yeah.
He didn't buy Class A at $80.
$80. Yeah, that'd be gotta be fantastic. Yeah, I think that would be it. I think I tripled my money on that. 300% return.
That's amazing.
Almost double and a half.
You know, it's a lesson to all of you out there watching or listening. Buy and hold. You know, buy good companies and just hold. There's no need to panic when the market goes down, you know?
Yeah.
So, all right. Tell us about your best investment, Johnny.
Mine has been Gevo and FuelCell. I picked up Gevo barely over $1, 107, and that stock's over, I think, around 12 to 13 right now. So that's about a 1,200% return. I'm killing myself for selling 3 times my position at 600%. If I would have held, I would have been up a whole 1,200%, but nothing but profit in those. So, and FuelCell, I got in at 250. Now it's at 17, 18. So those are massive returns for me.
You know, when I first signed up for Robinhood, I think one of the apps I got, or one of the stocks I got, was FuelCell, because I didn't really know anything at the time.
I got GameStop.
Yeah. Oh man. Oh man.
What?
I let it go because that was a dying company, though.
Yeah. Well,
it was built before all this meme stuff. So
little did you know, GameStop was going to be one of the most profitable companies on the market this year. Joke's on you. I didn't expect that. How did you not foresee a brick and mortar video game store going up like 1,000% in profit? I don't know how you didn't foresee that. You know,
well, because all the retail stores are dying. They haven't done much in e-commerce. Besides the Chewy CEO stepping on board, but this was before that. So it wasn't looking too good for GameStop, and all this digital stuff. People are getting away from retail stores, so it wasn't looking too good. So I dumped it.
We'll talk about GameStop a little later, because I want to touch on that when we talk about the meme stocks. All right, so we got your first investments, we got your best investments. So I know those were questions that a lot of people asked. So we covered that. So let's move on to the climate of the market today, and how we're kind of in this trend where fundamentals don't mean as much anymore as they used to. They do. Companies are getting pumped up and inflated based on just hype and you know, tweets from Elon Musk and stuff like that. And we see the stock market had a dip a couple weeks ago, or was it 2 weeks ago? People started panicking. Now it kind of rebounded last week, and we got the stimulus package passed recently. What are your guys' takes about the stimulus package that just got passed, and how do you think it's going to affect the market long term?
It's
hard to say long term.
No one knows. No one really knows.
No, I know.
Johnny doesn't know. I don't know. We don't know. We're surmising. We're guessing like everyone else. But you know what? Yeah, what you sow, you reap. If I know anything about history and lessons of life, it's you get to reap what you sow. So if they're sowing easy money and they're sowing the seeds for high inflation, we're going to get it. I'm not saying it's going to be fast, but someone's got to pay something at some point for the free money, for the debt, because they're borrowing the cash and then rolling it out to the public for free. It's like giving kids a trust fund. Like someone's got to pay for this at some point, and it could be the next generation or two. But unless the productivity of the United States builds and the world global growth goes up, with inflation, the value of the dollar is going to fall, which is maybe what the United States wants if it's got a lot of debt, right? It wants it to fall. It doesn't care. It's like printing its way out of debt. In terms of stocks and how that looks, like as soon as bond yields go up from the inflation tick up, and it won't happen this year or next, but maybe in 3 or 4 years at full employment, then interest rates will rise. And when that happens, growth stocks, it's going to get, they're already getting hammered because there's a rotation out of tech into value stocks. It's already happening. So it'll just accelerate it. Yeah. I wouldn't want to be in high growth tech stocks now, I don't think.
Which is, the thing about that is if you're investing in ETFs like VOO or an S&P 500 fund, a lot of those top companies are growth stocks like Apple, Microsoft, Facebook, Tesla. So I'm wondering how that's going to affect the breakdown of the S&P 500 and if in the next few years they're going to start shaking up the top holdings.
Yeah. I don't know if they're high growth stocks though. They're just like growth stocks, right?
Well, they're all heavy on tech. Like all the top 10 are pretty much tech.
Yeah.
And the best performing on paper.
Yeah, I'm wondering if it's a good time to start transitioning a little bit into small cap companies and mid cap companies that might have more growth potential.
I don't know if the caps necessarily have anything to do with it, but it's the industry, it's the sectors that will now will grow, and it's the sectors where people are putting their money where they're seeing value. So like it made sense that before a pandemic, if you held tech stocks and a pandemic comes and it's just like all the earnings of those companies explode because everyone's just on a computer living there, literally in their lounge room. So it made sense that Zoom was killer. It made sense that Apple crushed it. It made sense that all those tech firms crushed it looking back. But does it make sense now? Like if you're looking at value stocks, there's so much value there that you can buy undervalued companies now so much easier because everyone's money went into tech. Now everyone's money's gone out of tech into these value positions because they know it's a recovery trade. It's like they know the pandemic is now official, like the vaccine's working. It's balance of probability says that we're going to go back to normal.
Oh, for sure.
It's a matter of time. They're putting their money where their mouth or thoughts are. Yeah. So like, all those travel it's value, man. Like that's where the growth's going to be in terms of your stocks. It's not going to be in high tech. I'm not suggesting sell your tech, but to buy it now at these levels, doesn't look good.
Yeah, I was excited. It was last week, and when Apple fell to like 116, because I was like, we might not. I don't know if it's going to fall to this. It might take a while, but who knows? No one really knows. That's the only company I had my eye on. I was hoping it'd fall to like 100.
Revenue.
Yeah,
Apple produced $100 billion in the last quarter.
Yeah.
I'm comfortable with Apple.
Yeah,
I tell you something about Apple, if I can interject.
Yeah,
having a conversation with a guy about this. He's from Hawaii, and he said, Lloyd, what about Apple? You can't say that's not expensive, yada, yada, yada. And I was like, that's really interesting because Warren Buffett sold 6% of Apple recently. Now, it's his favorite company of all time. It's his biggest position. He hates selling companies. He hates cash. Why would he sell Apple?
Taking his profits.
Yeah, because why?
Because it was a ridiculous year. It was insane.
No, because it was over. Right. The market was saying it was overpriced. That's why he sold, right?
Yeah.
So he doesn't need to take the profit. It must have been so overvalued for him to sell his favorite company, right?
Yeah.
So here's the thing: if Apple's worth 2 trillion, right, market cap, and it's making 30 billion profit a year, right, or 38 or 34, I don't know what it's making in profit. Right?
I think it's over 100 billion.
So they had call it 100 billion in profit, right? Not revenue.
Free cash flow. They had like 100-something billion.
I think they had that much free cash flow.
Yeah.
In FCF, right? So let's go to FCF, free cash flow of 100 billion. So if it's a true $2 trillion company, its free cash flow yield is, what's that, 5%?
Yeah.
So its free cash flow yield is 5%. Okay.
The thing about Apple though is they could literally pay off all of their long-term debt and still have over $200 billion of cash if they wanted to. So it's like, clearly if you're going to buy it now, 10 years from now, it should be more valuable than it is now. Right. That's my thoughts behind it.
You know what makes it valuable though? The real long-term play for Apple is its buybacks.
Yeah.
Do you know what I mean? Like, it's borrowing money. Let's say it's debt, it's whole debt. It's borrowed that at less than 1%.
Yeah.
And it's buying back its shares with that debt that typically yield, a return on equity of like 40%. So it's borrowing for 1%. It's buying back its earnings at 40%.
Oh, so they're doing stock buybacks. I didn't know. I didn't know they were doing that.
They've been doing stock buybacks for a long time.
Oh,
I think
okay.
that's why Warren owns them. That's why Warren owns them. But it's interesting that its free cash flow yield is 5%. So as a company, it's not exactly undervalued.
No, it's definitely not
I mean?
No, I totally agree. It's definitely overvalued for sure. I'm not arguing that. I'm just thinking if I'm going to buy it, it's something I'm going to hold for a long time anyway. So like, it doesn't really matter to me if it doesn't go up in the next year or 2 years, you know what I mean? It doesn't matter. But I could definitely see how people would get nervous and be like, Apple's not moving, I'm getting rid of it. Right. I definitely understand that.
I think it's quite fairly valued at the moment because for a tech stock, you can see most of the PE ratios are like 70 and plus sometimes. And Apple's only hanging around like around 32, I believe. So they
are like almost like 3.5 times book value right now for the PB. So they could definitely come down another $10 a share or something.
Yeah.
I think the thing is, I'm in it for 102. So
yeah. And another thing is the EV hype. We see all these EV movers going tremendous. And once Apple gets a good partner, if they get like Volkswagen or Hyundai or something, like, man, I think it's gonna go up like 10% just from off that.
I think the value of Apple is in its stickiness of its core products and its
loyal customer base.
The loyal customer base, exactly.
Service businesses, and they got pricing power. So Warren buys it because they got pricing power, which means, let's be frank, if they put the iPhone up by $300 or $400, we would still buy it.
Oh, of course.
It's got tremendous pricing power, like Coca-Cola, right? That's why he's bought it. But it's buying back its shares with cheap debt. It's got a great capital management team, got a great brand, the best in the world.
The Apple Watches, they're exploding. I mean, everybody has them. Everybody has them now.
And the iPads and iMacs that all the schools had to buy for this new Zoom and this new age. Apple hit big for this pandemic.
You're looking at a company, you got to be careful looking at its products.
Yeah.
You have to be careful looking at its product. It's beyond the products. So like, for example, this is amazing. How amazing is it really? It's so amazing. You can put it up by maybe $1,000 and people still not only want to buy it, need it.
They would stand in line.
Right?
They would stand in line.
Sleep over stores and everything.
They need it. So like,
you know what it is? Yeah. I was going to say, you know what it is? It's their ecosystem. It's how everything is connected to everything. And you want everything because it works so well together.
Yeah. And they took out chargers and everything now, and it doesn't matter. It doesn't matter.
The new iPad has no charging block and it has a different charging cable. I'm like, what is this? Like, now I have to buy another charger, and I'm going to do it because I'm foolish. So I'm going to do it. But
I think that's what makes Apple powerful. It's stickiness of its products and its ecosystem. It's recurring income stream business that is growing, but it's pricing power of its products. And it's the same as Coca-Cola, but its share buybacks put a floor in the stock. I don't own any. I really want to own some. I think it's the best. But at 2 trillion plus, I would like to do it at 1.5 trillion if I could. For buy that company, right? Yeah. So it would come back into the 80s, man, I'd buy it. I don't know if that's possible, but
in the 80s, wow, that would be a really bad news for the market if that fell to the 80s. That would be a market disaster. Yeah. All right. Well, we don't want to make this too much about Apple, so we'll keep it moving.
Right.
People are like, all right, enough about Apple. All right. So we talked about the market.
Meme stocks.
Let's get into meme stocks. So that's what everybody wants to know. All right, Lloyd, tell us, are you buying AMC and GameStop tomorrow at 9:30 when the market opens?
No, no. You know why? Because it's so important as investors, or whoever's listening to this, that you don't need to know about all the noise. Like it just doesn't matter. I have no interest in Dogecoin, GameStop stock, any meme stocks, any crypto. I just don't need to know anything about that. All I'm buying is businesses that I understand enough, and I know that they're selling for a little bit less than what they're worth, and I hold them forever.
Right.
That's it. Like it's so simple. I don't need to know anything about this. I'm not buying that stuff. Here's why. Here's predominantly why too. I need to be able to put in $100,000 in a position. Like we talked before about returns and stuff. The reason why I don't have 12 time returns is because when I put in a position, I'm putting $100,000 in there. Like, and that's like, I need to know a lot of stuff about the trajectory of the stock and the company and the insides of it if I'm putting all that money in there. If I was putting $2,000, man, I'd buy Dogecoin. I'd buy like GME stock. I could give a shit if I lose $2,000 or 5 or 10, right? It's recoverable. So if you're going to be buying meme stocks, I would suspect that you're putting $100 in it. And the reason why, if you go through the group and people are like, oh, I'm in this and I'm in this and I'm in this, because they're putting $10. Like, that's like going to the horse races with $10 in my pocket. I could give a
money
shit.
that they can risk.
Yeah, totally. So if I'm going to put money, I really just want to throw in the fireplace, I would buy all those stocks. But it takes up so much of my time and energy and effort to look at them and place it and do the trading. It's not even worth my time. So I'm looking at placing big positions in good quality businesses that I can hold for a really long time. They're going to pay me cash flow, growing value. So my 100,000 becomes 300,000, 400,000 over time, right? And gives me cash flow at the same time. That's my investing strategy. That's how I built my portfolio. And I'm not going to be doing anything different to that over the next 30, 40 years. You know what I mean?
So it's all right. Nice. Well, you heard it, ladies and gentlemen. No Dogecoin, no AMC, no GameStop. I'm trying to get them to wear a Bitcoin T-shirt for one of the episodes. I don't know.
Oh my
to the
God.
moon.
I've been talking about it.
Bitcoin I'm gonna send them a to the moon T-shirt.
Send me one and I'll wear it. But
I'm going to.
It's coming.
I'm going to. All right. So what do you think, Johnny? Like, where's this going? Is GameStop going to hit that. Is GameStop going to hit 1,000? Where are we going here? Like, what's going to happen?
Lloyd's right about daily movers and stuff, but I think this scenario is different. This GameStop, AMC, all these Reddit movers, I think they're pointing elephant in the room with these hedge funds. And with these stimulus package coming, a lot of it's going to be going into these specifically GameStop and AMC.
You're right about that. Yeah.
Truthfully, I could see another squeeze coming. I could give the general market a little pullback because I think these hedge funds might have to pull out positions out of all these other positions that they're in to cover their asses on these meme stocks. And I see it coming. So this scenario, I think we do have to pay attention to it, because I think it might have an effect on the general market. What's going on here?
GameStop's about to hit a 2 trillion market cap. It makes no sense.
That's incredible.
But only if people that condoning this only put money in that you could afford to lose, because it's going to come up and it's going to come right back down.
It's going to be fast. When that sell-off happens, it's going to be so fast, and you're going to lose everything if you don't know what you're doing.
Yeah, if you don't know how to trade, stay away, because
even if you know how to trade, you should probably stay away. Yeah. Oh yeah.
Yes.
It's crazy because now every week there's a new one on Reddit. Every week there's a new one, and we see it in our group. I mean, I know everyone doesn't see the questions because we get hundreds, even thousands of pending posts sometimes.
Yeah.
And we'll see the same questions about these companies I never even heard of. And I have to look this up because I'm like, man, this is like the 20th post I've seen about this. And I'll look it up, and it's some like stock that's 80 cents right now. And I'm like, how are
it's
people
up 300% on the day?
Yeah.
The people are always following the daily movers. So we really have to try to limit it. We only like accept one post maybe, because we're trying to save people, because these people they don't say it's a trade. They're saying put your money in this and you guys are gonna triple your money and stuff. And they ain't giving people a warning that it's a trade. You get your money and get out. It's
That's what we're trying to
moves
do.
are risky.
That's what we're trying to do. That's why we don't allow a lot of that stuff, because that's so
Right.
dangerous. You know, for
Right.
someone that's brand new, they're going to be like, oh, you know, these people are saying buy this. And if they see, they'll follow the herd. They see a bunch of comments saying to the moon, yeah, buy it. And they don't know any better, you know?
Yeah. Once they see the rocket emojis,
That's it.
all those cool emojis that they're Googling and they're buying.
Yeah.
It's kind of like, I feel like the SEC one day is going to nail someone for market manipulation based on the grouping and the communication of pumping a stock, a pump and dump.
Yeah.
Like that's really what this is becoming. And the more it happens, the more prevalent it gets. The SEC is just going to slam people and say, if you're seen to be in any social accounts promoting a stock with the people behind you, we're going to come get you. Like, do you know what I mean? Like,
Elon Musk, he's
truthfully,
playing with fire by talking about Dogecoin all the time on Twitter, and they're going to investigate him.
He's getting sued.
Definitely.
He's getting sued by a Tesla shareholder right now for they're telling the market that it's overvalued, even though the guy made 5-fold return after that comment. But he's getting sued for
market manipulation.
Yeah. I saw a stat on MarketWatch the other day that 39% of Americans buy what Elon Musk recommends in tweets. 39%.
Yeah.
Him and Kathy Woods. Are the
Kathy
two most
Kathy Wood,
people.
The ARC chick?
Yep. Yeah.
Yeah.
She just got slaughtered the other week.
No, I know. ARC is lost like
people they call her Queen Kathy and everything.
Oh, they love her. They love her. ARC lost like 20% in the last 3 weeks, and they just got slaughtered. And you know why? Because a lot of ARC is Tesla.
Heck.
You know, and Tesla's getting. I
don't
understand. Yeah.
Do people understand? Do people understand? Like, look, I'm a fundamentalist, right? So that's my position. What's great about this is we all have different positions and opinions, because I might be wrong. But what's fascinating, let's go back to the most simple metric of back of the cigarette packet valuation formula, which is the PE ratio. A lot of people don't understand this, but price is obviously the best way to flip it around is earnings to price ratio. So a PE ratio is your price of your stock divided by the earnings per share of the stock, or the price of the whole company divided by its whole earnings, right?
Yeah.
So if you flip it, it's like, give it a perfect example. If you buy a house in the United States for, let's say, $100,000, okay? You can still do that, right? You can buy houses for $100,000 still? Maybe
foreclosure.
In some locations,
right?
Yeah.
Let's say, just to keep it simple, the numbers, $100,000 for a house, okay? Let's say the house brings in rent of, say, I don't know, just to make this simple, $10,000 a year income. The price to earnings ratio of the house as an investment is 10, right? The PE ratio is 10. 100,000 divided by 10,000 is 10. Okay.
That means it would take you 10 years to make your money back.
Correct. That's right. Correct.
Yeah.
So stocks are no different in terms of their PE. This is all PEs. If you want to use real estate as the example, it's identical. It's the same. So let's say a house, would you buy a house that was producing 5,000 a year? That's a PE of 20. It's getting expensive. If you buy a house in the United States for $100,000 and it's giving you 5,000 a year income, you go, oh, it's pretty expensive. I don't know if I'd buy that house for $100,000, right? PE of 20. PE of 20. If you go and say, well, I've got the $100,000 house in America and it's going to give me $1,000 a year, it's a PE of 100. Would you buy that asset, that real estate asset, for $100,000 if it was going to produce 1,000 a year, right? Yeah. 100. Okay, check this out. Tesla is 1,200. 1,200. I mean, it's going to take that company 1,200 years to earn its market cap back.
I've been saying
Tell me how that is not overvalued. Even in the most insane growth prospects possible, it's still overvalued.
It makes no sense. Well, that's the thing. I don't understand how people are still buying Tesla for $700 a share. I don't understand.
I don't know. I think it's Elon Musk. Like,
Well, I think they look at Amazon and go, well, Amazon had a PE ratio of like 1,000 forever. And now it's finally earning profits, and that's just gone ballistic. So they're probably thinking, well, these fundamentals don't factor in the potential growth. But why would you want to bet on something that's unknown, like the growth of Tesla? If Elon Musk gets hit by a bus, by
If you,
Right.
yeah, that company's done. They'll lose probably half their share value in one day, and
Yeah.
then they'll actually be worth something.
Yeah.
Then the company
Hey,
will
well,
actually.
I'll tell you what would be a good bet: a life insurance policy on Elon Musk.
I bet you that companies do that. I was reading in an article the other day that like Apple has a ridiculous life insurance policy on Tim Cook,
what?
like an insane. Yeah, they even have bodyguards. They hire bodyguards to follow him around. I'm sure they do the same thing with Musk. So, but all right, so we got 8 minutes left. That's what Zoom is telling me. So we'll try to get through this. Yeah. Where were we? Oh, so we finished the meme stocks. So let's get into 2 questions that people had. This is a good one. And this one I didn't really know the answer to. So if I invest, this person says, if I invest $1,000 and in 6 months, it's $5,000. If I cash out only $1,000 and leave the rest in, do you have to claim taxes on it? I think you do, because you're taking that out of the profits, right? Because you can't take it out of a certain lot, right?
Yeah, you can't say that that's your original position. It's Uncle Sam looks at it as capital gains.
You know why? It's because you're selling it for the gained value. So like you're selling the stocks at the current price. So yeah, that's why. It'll deduct, depending on how many number of shares you sell, you're taking the profit from those number of shares you bought here, and you're selling them for a profit of the same number of shares up here, and they take the gain. Yeah, so it's.
I think it will let you sell older shares first, so you might be able to get a lower tax rate. I know Fidelity has something like that, where you could take your shares, like if you owned it for a couple years, but you kept buying into it, maybe it might let you use the older shares to get that 1 year capital gains tax rate. But I'm not 100% sure. I could just be totally making that up.
They just average the cost down, so your average cost is calculated automatically as you buy up, and then it'll take the capital gain from the average price minus the top price.
Makes sense. So that was one that I thought I picked that question because I thought that was one that a lot of people might be confused about. Because I thought, like, initially when I read it, I'm like, yeah, of course you have to pay taxes. And I thought about it, I'm like, wait a minute, that is a good question that could confuse people.
Yeah.
So
I would be expecting to pay taxes. Definitely.
Always expect to pay taxes. If you're not sure, always expect to pay taxes.
Yeah. I think we should all know that by now.
Yeah. Oh yeah. Always. So one question, and this is probably a great one for Lloyd because of his money grows on trees and his side hustle. How can I make money work for me instead of working for money?
Yeah.
Well, a good example is if you buy, even Chevron recently, when Warren Buffett bought it, was paying a 5.5% dividend yield, I think, which is really high for a US company of quality like Chevron. So let's say, for example, you put in $100,000, or you created $100,000, or you invested and it grew, whatever. In Chevron, it will produce $5,000 a year to you in dividends. So if you have a $100,000 money tree, you're putting your money to work. It's paying you $5,000 a year for doing nothing. And that's how you get your money to work for you. You can also do it like, and Johnny's probably got some points on this one, but it's like if you put your money in a stock like GME, like let's say you went in one of those stocks and you put $1,000 in and it went to like a trillion, and you made tenfold your money. Okay. Then you sold it. Then your money's still working for you, but you have to you got to be careful of doing it that way because it's all based on emotion and capital growth and stuff. Whereas if you actually build your portfolio over time, it will pay you income. You either have to start a business that's recurring customers, or you have to invest in a stock that's going to produce dividends. Either way, you've got to have money coming to you automatically, but it takes time and effort.
Yeah.
What do you think, Johnny? You got anything for the people out there? You got any advice?
Yeah. I would say, well, because trading, you still have to work for your money while you're trading. So, stock
Yeah.
market wise would be income stocks, of course, the dividend payments, like what Lloyd was saying, but he covered that very well. So, I would say e-commerce, like if people have a general talent or knowledge about something, or they can make something, like you guys should definitely put your money into investing in yourself and open up your own business. Because in 2020, e-commerce grew the most in the company's revenue. Companies produced the greatest revenue increase in e-commerce during 2020. So if you have a talent, knowledge about something, this is a day and age that you could put it to use. And we have so much social media platforms and stuff now. It's it's simple. It's simple. You just have to learn and study, and you can make it happen. You just got to invest time and money into yourself.
I
For
put
sure.
well, on Johnny's point, that's so true. We started a business 7 years ago for $500 each, and we worked hard at it, and it now pays us $6,000 a week net profit income every Monday. Every Monday, 6,000 a week. Right? People go, how do you build a
Nice.
portfolio? Right? You create that cash flow and then you invest it. That's going straight in the stock market.
I
Right?
want to talk about that. So we got a couple minutes left. I want to talk about the side hustle and where people can find you to start doing that or look into that.
Yeah. Now, just so caveat though, that took time to build up. It started with a couple $100 and then it was time and effort and work. So you don't just push a button.
I can't start off making
Yeah.
$6,000 a
No,
week.
you can't.
Forget it. Forget
Right,
it.
yeah.
I'm out.
Disclaimers. Yeah. So, yeah, you go work it out. But if you want to learn more about that, you go to my Instagram, Lloyd James Ross. There's 2 L's in my name, Lloyd James Ross. And in my highlights in my stories, there's a story highlight that says side hustle. Click that and watch it, and then you'll learn a
We'll
bit.
definitely
Nice.
throw that in the link, and we'll also throw Johnny's info in the link too, so people can find it. And also, I think I should say that we are not certified financial advisors. This is just educational, so you don't have to go and buy what we tell you to buy, or we're not recommending anything. We're just sharing our personal knowledge, and hopefully we can help some people out. So
Yeah.
Sure.
I think that's all. And thanks for watching, and thanks for joining, guys.